All right, so hello. About impact investment. It all sounds really great, and we've got the slides, and there's only one problem: greenwashing, right? And we don't really usually feel comfortable talking about this, but we don't have a really complete view of the story until we address this elephant in the room. Now, the problem here is that oftentimes impact investment embeds perverse incentives into social enterprises. I'm sure that you all, of course, are familiar with cases of B corporations being sold to Unilever. Also things like, of course, the Tom's Shoes example, where, Blake Mikowski wants to buy one, give one, to Africa. And he had really great intentions, but all of a sudden it's like, oops, I'm a billionaire. That wasn't supposed to happen. So the problem with social enterprise, as well as with impact investment and ESG, is that it is adopting too many of the tools of the commercial ecosystem. Now, to really understand the core of the problem, you need to understand the concept of financial extraction. In general, if I am a VC, whether it's commercial or impact, it's not a big difference, you need to ask yourself the question of how exactly are these VCs getting paid? So usually what you need to look at is things like fees, right? Because, of course, most fund managers in finance get paid by fees. The typical fee structure is something called the 220. So basically 2% asset under management fee, 20% carried interest. I'll explain what this means. So let's start with the carried interest. If I am a VC and you are my portfolio company, if you grow exponentially and then exit selling your company, maybe to Unilever, I get 20% of that. So that carried interest, you can say, embeds the growth imperative into startups. If you want to get rid of the growth imperative and instead allow startups to be able to grow organically, maybe for the long term, maybe without selling out, then it really is as easy as getting rid of that 20% carried interest from the fee structure. Another thing also is that the asset under management fee, 2%, is also highly extractive. Most people don't realize this. If you think about a 2% mortgage, then you start understanding the power of compounding. And I can tell you, if I were going to retire and I put my money into a retirement vehicle like a 401c3 or Roth IRA, given the historical performance of the stock market over the last 25 years, with a 2% management fee, I will have literally paid 2/3 of my returns to the fund manager. See, that's not really very helpful. The other problem that we have with our startups is that we are treating them like factory-farmed chickens. So, we got this startup, and then we force-feed it with investment capital so it gets plump and juicy and attractive looking, right? So that for, in 3 to 5 years, it leads to the moment of liquidation, which is the moment when we pull the financial value out of the company, thus leaving a dysfunctional carcass of a company left over. Of course, anything with hypergrowth this quickly is going to be bleeding money, right? Because if you're hiring people this fast, well, people are expensive. The other route to exit is things like either getting acquired. See, I actually work in the cybersecurity industry. It wasn't mentioned, but I'm CEO of a 50-person cybersecurity company. We are awesome acqui-hires because it's hard to find security staff. But what happens then is people just want the personnel. Every small cybersecurity company is acquired, and oftentimes the products and services that we're working on are just discarded, because that's why we weren't acquired in the first place. Now, the other problem also is that we're told we need to be unicorns, right? And of course, a unicorn is a company with a $1 billion valuation or higher. Now, the problem with unicorns is they have a dirty secret. 90% of them are bleeding money. Of course, the famous example is WeWork, that is sort of bleeding money 5 times faster than it's getting it from customer revenue. Now, there's a few problems with this. The first problem is people don't ask often enough, with those cash-bleeding unicorns, whose money are they spending? If you follow the money, roughly 65% of the money going into particularly US-based VC funds are pension funds. So basically, those cash-bleeding unicorns oftentimes are spending our money. Right? The other problem is that another form of exit are things like IPOs. What is actually happening here is we are essentially taking this inherently cash-bleeding thing, hyping it up, pumping it up, visionary founder, we're going to change the world, right? And then essentially we're dropping it basically onto the public markets. And then, of course, if it's cash bleeding before the IPO, it's probably still going to be cash bleeding after the IPO. But see, nobody cares because they are speculating. And they are betting on something called the greater fool theory, that it doesn't actually matter what you're buying, as long as there's a fool that comes after you who's willing to pay more. Right? And this is the basis for all kinds of things. I mean, conceivably, cryptocurrency, also almost the entire stock market, tulips, there's all kinds of things. But the point here is that this, in a way, is almost kind of a pump and dump scheme onto the public markets, which should lead us to be asking the questions of why is this even legal? The other problem here is that this deforms the markets. See, you can call me a chauvinist, but I think that real businesses are profitable. We actually have customers and we bring in more money than we spend, right? Isn't that the principle that should be behind running a business? For a lot of SMEs, it does work this way. But the problem, though, is that getting these really large cash injections from the VCs, the problem is that what they're attempting to do is to essentially get a monopoly position, right? Because they're trying to, with this hypergrowth, to get enough revenue, essentially, to try and cut out everybody else. Also with the unicorns, we say them like it's a good thing. One of our princes in the Netherlands also constantly says, we need more unicorns in the Netherlands. But we need to stop and think what we're actually asking for. See, the problem is that you can take that fancy word unicorn and you can replace it with the words pension fund subsidized monopoly forming. Because that is exactly what it is. So, coming back then to the impact ecosystem, there's a couple ways that we need to change things. The first way is, remember when I talked about this 220? So basically, there are some VCs that are out there that are reforming their fee structures. For example, Snowball Impact Management in London in the UK, they have a fund and they got rid of that 20% carried interest. Cool, huh? And then they also took that 2% asset under management fee and they changed it into the cost of running the business, assuming middle-class salaries and a pension. Because God forbid fund managers be middle class. The other thing that Snowball did is they also put the entire thing underneath a foundation. I'm not sure if any of you all have ever heard of the concept of steward ownership. But steward ownership is the concept of essentially self-ownership. It's combining tools like foundation ownership, purpose and mission in your statutes, and the most important part, golden shares. And golden shares are needed to prevent you from getting rid of the mission, in your statutes, and also to prevent you from selling the company. Foundation ownership by itself isn't enough. You can see a case of where this went wrong with OpenAI, right? They started foundation owned, but because of the lack of the golden shares preventing the sale of equity, thus they were sold for, what was it, like 12 billion or something, to Microsoft. That's not the intention. So these golden shares are an important part of steward ownership. Now, the point is that Snowball is not the only impact VC that has reformed their fee structure and their governance structure this way. Purpose Ventures, Of course, this conference is co-organized by Purpose Schweiz, so not small advertisement. But but the point here, though, is that also the impact investment arm of Purpose also is implemented as a steward-owned co-op, and they've also been doing some interesting things with reforming their fee structures as well. So with the impact VCs, the real question that you want to be asking them is, if it's really about the impact for you, what would you feel like about reforming your governance structure and reforming your fee structure, making your fund steward-owned, replacing the 220, with something that really locks the value of the fund into the fund, thus ensuring that the value is not extracted towards the fund manager and instead all fees and returns are being recycled back into the fund maximally, which leads to what it's actually supposed to be leading to, which is cultivating the maximum amount of impact businesses. It's the same thing also with CEOs of social enterprises. To avoid the Tom's shoes effect, we too, as CEOs, can also choose to make our companies steward-owned. It just so happened that with my cybersecurity company, I did exactly that. 9.5 years ago, I sold my company for €1 to a foundation. Worst sale ever, right? But I did it because I wanted to ensure that my company would stay social for the long run. The other thing that I did that's also unusual is use an interesting Dutch tax construction that forces me to donate 90% of my profits to charity. The last 10% is my cash flow buffer I use to make payroll. And in the last 10 years, we have grown to 50 people. We've had hundreds of customers, including Google, the European Commission, the Dutch energy grid, banks, insurance companies, telcos, hosting providers, and also not-for-profits for whom we work on a zero-margin basis at cost price. And we've also donated over €1 million to the NLNet Foundation, which is a Dutch charity who subsidizes open-source projects, digital rights initiatives, and anything for an open internet. So to conclude, even in the impact ecosystem, we need to question the dominant narratives. Because at the end of the day, financial extraction is the root cause of our necessity for never-ending growth. And financial extraction is the original sin of business and finance. And if we really want to make things better, we need to figure out ways of getting rid of it. Thank you.